The casino has gotten very attractive. That's not a headline from a Vegas tourism board. That's Warren Buffett, the most disciplined investor alive, describing the stock market. When the Oracle of Omaha compares Wall Street to a casino, you'd think he's warning you to run. But that's not what he meant. Not even close. Today, we're breaking down exactly what Buffett meant by that line, why Berkshire Hathaway is sitting on a record cash pile while saying this, and what it tells us about where markets actually stand right now. To understand this quote, you need to understand the context it came from. Buffett has used casino language for decades, but always with precision. For Buffett, a casino isn't a place of risk. It's a place where the odds are known, the house has an edge, and most players lose because they don't understand the game they're playing. When he says the casino has gotten attractive, he's not talking about gambling. He's talking about mispricing. He's talking about a market where speculation has pushed prices so far from value that disciplined capital, patient capital, can finally find an edge again. In other words, the crowd is doing something foolish, and that foolishness is creating opportunity. Buffett has always drawn a hard line between speculation and investing. Speculation, in his framework, is betting on what other people will pay for an asset tomorrow. Investing is buying a piece of a business based on what that business will earn over years and decades. When markets get casino-like, it means more and more participants have stopped doing the second thing and started doing only the first. Options volume spikes. Meme stocks rip. Retail trading apps gamify the experience with confetti animations for completed trades. And here's the key insight: that environment doesn't scare Buffett. It excites him. Because casinos exist because most gamblers lose, and somebody has to be on the other side of those bad bets. Berkshire Hathaway, with its hundreds of billions in cash, structurally wants to be on the other side of the table. This quote doesn't exist in a vacuum. It exists alongside one of the most talked about numbers in all of finance right now, Berkshire's cash position. Buffett has been a net seller of stocks, accumulating one of the largest cash reserves in corporate history. To casual observers, that looks like fear. To Buffett, it looks like ammunition. A casino getting attractive to Buffett doesn't mean he's about to start day trading. It means valuations are reaching a point, or markets are behaving in a way, where his discipline, patience, and capital can eventually be deployed at prices that make sense. He's not avoiding the casino. He's waiting at a specific table, with a specific bankroll, for the odds to tilt his way. This is where the story gets even more interesting, because Buffett won't be the one pulling the trigger forever. Greg Abel, set to take over as Berkshire's CEO, inherits not just a company, but a war chest. And the timing matters enormously. If markets stay casino-like, overvalued, speculative, disconnected from fundamentals, for an extended stretch, Abel could be the one who finally gets to deploy that capital at scale. Buffett built the discipline. Abel may get the opportunity. Some analysts even argue that Buffett's recent commentary isn't just market analysis, it's a message to shareholders and to Abel himself: stay patient, the moment is coming, and when the casino stops being attractive and starts being cheap, that's when you move. Buffett has used this exact framework before. In the late 1990s, during the dot-com mania, Buffett famously avoided tech stocks and was mocked for losing his touch. When the bubble burst, Berkshire was sitting on cash and bought aggressively into the wreckage. In 2008, the world was in panic. Buffett wrote his now famous op-ed, "Be greedy when others are fearful." He deployed billions into Goldman Sachs and General Electric, while everyone else was selling. Each time, the pattern repeats. Speculation rises, Buffett waits. Speculation collapses, Buffett buys. The casino comment fits squarely into this same playbook. He's not predicting a crash. He's describing an environment, and reminding investors what usually happens next. So what's the lesson for regular investors, including those of us tracking Nifty and Sensex rather than the S&P 500? First, don't confuse activity with progress. If your portfolio feels like a casino, constant trading, constant excitement, Buffett's framework suggests you may be speculating, not investing. Second, cash isn't laziness. Holding cash, or continuing disciplined SIP investments through expensive markets, isn't missing out. It's patience with a purpose. The investors who keep some dry powder are the ones who can act when valuations finally make sense. Third, market mania is a signal, not a forecast. Buffett isn't telling you exactly when prices will fall. He's telling you that when the crowd treats the market like a casino, the smart money quietly prepares for the next decade, not the next quarter. The casino has gotten very attractive is, in many ways, classic Buffett, a simple line carrying a complicated truth. It's not a warning to flee the market. It's a description of a market that has drifted from value towards speculation, and an admission that, for a patient investor with capital and conviction, that drift creates opportunity. Berkshire isn't avoiding the casino. It's positioned at the edge of the floor, counting cards, waiting for the table that finally favors the house, or in this case, favors the long-term owner of real businesses. Whether you're investing through the NSE, the BSE, or any market in the world, the principle is the same. Understand the difference between speculation and investing, and let patience be your edge. If this breakdown helped you think differently about markets, hit subscribe for more deep dives into Buffett, Munger, and the principles of real value investing. Drop a comment. Do you think Greg Abel will deploy this cash pile differently than Buffett would have? Let's discuss below. See you in the next one.